We're live. Great to have you join us. For those I haven't met yet, my name is Dinesh De Silva. I'm the founder and the CEO of Netstripes. I'm absolutely excited because this is our 6th annual tax webinar with the absolute experts at Grant Thornton. Today, we have Raj Deepan and Bianca Patrick. Great to have you join us, guys.
Great to be here. Thanks for having us.
All right. Amazing. Raj, I'd like to get started with you. Ladies and gentlemen, again, if you do have any questions, go to the Q&A and enter your questions in there, and I'll come to them during or after, but I will not miss your questions unless we completely run out of time. Raj, I'm going to get started with you. Is that okay?
Absolutely.
Tell us, we had a budget not too long ago, and what were the most crucial parts in the recent budget for small and mid-sized businesses and individuals that we must know?
Yeah. No, thank you, Dinesh. I just thought I might take a minute just to talk about high level what the budget had, just for the benefit of some viewers who might not have, seen it or captured all of it. So, the last couple of years, Jim Chalmers, our treasurer, gave us a surplus budget, 15.8 billion and 9.3 billion in the last 2 years. But unfortunately, this year, we've got a budget deficit of 27.6 billion. So for 24-25, and growing out to 42 billion for 25-26. So unfortunately, we're not in the green, we're in the red, right? Or not in the black, but we're in the red. And that could be the impact of the cyclone as well. We had Cyclone Alfred, so that's part of the reason. But the bottom line is, Labour has a reputation for spending, and the spending has come back, and we're now in a deficit position. So in terms of where the money is going to be spent, if you looked at the budget, it was mainly Medicare. So Labour ran a Medicare budget, so 8.5 billion in terms of the Medicare spend. But in terms of the other big items in the budget, $33 billion for housing. So as you know, housing is a major problem. $17 billion for infrastructure. And the third one, which is tax cuts. And I'll talk about that in a second. Tax cuts, $17 billion for tax cuts. And the fourth one being Medicare, so $8 billion for Medicare. So these are the big budget items that was in the budget, and resulting in a deficit for this year and then for next year as well, and overall blowing our sort of overall deficit or debt level close to $1 trillion. So let's get into $1 trillion, which is a lot better than the US, which is at $33 trillion, as you know. In terms of tax impacts for everyday Australians, there's proposed tax cuts in not this year, in the year commencing, or not in the year coming, but in the year commencing 1 July 26. The marginal tax rate at 16% is going to go to 15%, and in the year 27, they'll go from 15 to 14%. So they're reducing that marginal tax rate, which is that second bracket, up to $18,000 is tax-free, 18,000 to 45,000, was taxed at 16%. That's going to go to 15% in July 26 and 14% in July 27. So a little bit of saving. The average Australian expected to save about $500. So $500 in tax savings. They're also increasing the Medicare levy threshold slightly. So for the year coming for 24-25, it's at the moment it's 26,000. It's going to go to $27,000, 27,222 to be precise. So slight increase in the Medicare levy threshold. So not significant, but if you're going below that $27,000 number, you don't pay any Medicare levy. In terms of small businesses, not a lot in there, unfortunately, for small businesses, apart from the energy bill relief that's been extended for another 6 months. So if you're a small business and you're going to save $150 for every 6 months for the next from July 25 to December 25. $150 for 6 months. That's $75 a quarter. So first quarter of next financial year, $75, and the following quarter, $75. So unfortunately, I don't have much else to give you, right? I mean, this is all that we got, right? in the budget. So there isn't a lot there for small business, unfortunately, right? And also for individuals, there's a little bit of tax relief, but that doesn't come in till July 26th.
So let's summarize. This is the third budget Jim Chalmers did. And from a business perspective, it amounts to really a nothing budget.
Yeah.
You said there was massive spending, and the spending took us to a deficit. We have $1 trillion debt now.
Yes.
So these are massive numbers. And you mentioned Medicare, but apart from that, NDIS was a huge spend as well. So again, for the businessmen who are listening to this live and on the social media channels, we're going to share this with them, and on YouTube, we need to make a fuss about this, because businesses, small businesses, and mid-sized businesses are 98% of all businesses in this country. They are an absolutely important part of our economy, and we must be taken notice of. We create a majority of employment. So, and we can't be ignored again. We were ignored for three budgets. So our opposition is going to be weak. And so we can't depend on the opposition as well. So this is really a call out I'm making to everyone who is in business. We must really, through our social media, through our letters, through our emails, through our local members, we have to make our voices heard. If you listen to, I do a bit of stuff on Twitter or X as it's called now. Get on my channel, follow me, and I'm constantly in the ear of Jim Chalmers and the Prime Minister. Not that I don't like them or anything. I want them to take small businesses, mid-sized businesses, all businesses seriously. That's Bianca. The next question was for you, but I had to make a little statement there. I hope you do.
I agree with what you're saying, Dinesh. Yeah.
It's so distressing that all three budgets, businesses were marginalized, and that's not good enough. The next question is for a research and development expert, Bianca. What's happening in the R&D space from a tax incentives perspective that's happening right now that businesses must take note of?
Yeah, sure. So if you don't know already, the R&D tax incentive is the Australian government's key program for encouraging companies to undertake R&D in Australia. It's an entitlement-based program, so it's not competitive. If you're undertaking eligible activities and meet all of the requirements, you can access the program in a particular year. It is an annual program. In terms of what's happening in the space, the program hasn't changed too much in recent years, but a few sort of things to note is a strategic examination started earlier this year. So throughout this year, they're doing a review of the program and seeing if there's potentially ways to sort of better align it with the government's strategy on innovation. The output of the review will be a report with, some ideas, thoughts, suggestions of how to potentially improve and change the program. That will be given to the government, and then I guess we'll have to wait and see what their sort of response is to that, whether they make any changes or not. Another point to mention is the transparency report. So at the end of last year, for the first time, the ATO released a list of every applicant for the R&D tax incentive. So that was data from FY22, and it's something that they're going to start doing each year, but it's sort of a 2-year delay on the data coming out. The report lists all of the companies, so it's their company name, their ABN, and then total expenditure. So it's quite interesting to see who is claiming and who isn't claiming. And a lot of companies are finding it interesting as a way to benchmark their R&D against competitors or other players in their space as well. The report included, I believe it was 11,500 companies, which is quite a big number. And the spend on R&D ranged from the smallest end of about 20,000, which is the sort of minimum spend to make a claim, up to $200 million, which is
200 million.
Yes, which is quite a big range. The 200 million plus claim was Atlassian, so they were the largest claimant in that year. But that being said, the average sort of claim was about 1 million. So yeah, it is quite a range there. Another thing to flag as well, there are some changes to the annual application form that are going to be made. We don't know exactly what those changes are yet, but they will be sort of going live on the online portal from 1 July, I believe. So if you've started your claim early, which is great, I always suggest that, just keep in mind that some things on the portal might change. I'm not sure if you've already put information in there, if it may be deleted. So just keep that in mind and make sure you have things saved somewhere else as well, but also keep an eye out for what those changes might be. Another thing I'm seeing in the space is there's a lot of R&D financing companies popping up. So an R&D financing company is a company that offers companies the potential to get a loan against an expected R&D refund. So companies with a turnover of less than 20 million, if you're not in a tax paying position, you can potentially get a refund through the R&D tax incentive program. So the financing option just gives you the ability to access that funding earlier and during the year. Some companies will get loans on a quarterly basis. So it's an option to consider if you do have cash flow issues and want that cash earlier.
Bianca, I know a lot of businesses who claim on R&D, but a lot of businesses don't know this scheme is available and they even qualify. And what can you tell these businesses who don't know whether they'll qualify or because every business should be doing some sort of R&D in whichever industry they're in. What's your advice to them?
Yeah, so there are quite a lot of rules in relation to the program. So I would suggest speaking to an advisor that has a particular expertise in the R&D tax incentive, and just have, often from even just like a 20-30 minute initial chat, you can probably get a sense of whether it's something exploring further for you. But some triggers that you might be doing eligible activities can include that you're developing or improving a product, process, or service. That really can be in any industry. The fact that you've undertaken a project and maybe there's been challenges, issues, failures, what's keeping the team up at night. If there's challenges that they're facing, they're trying to overcome them, that can be a flag that maybe you're undertaking something that actually is quite complex and maybe does meet the requirements. Sometimes the fact that you couldn't just buy something off the shelf and just plug it in, whether it's a software, whether it's a product, that you have to actually do some development yourself or get another company to help you with some development. So those are some of the flags that if they sort of spring to mind and apply to you, it might be a program worth looking into.
Thank you. You mentioned Atlassian got 200 million. That's a huge amount. I was at a talk, Mike Cannon-Brooks of Atlassian yesterday, and they mentioned they were building this massive building in near Central Station, Sydney.
Yeah.
Hopefully, the 200 million is not going towards the building, and it's all.
They're a big company.
Yeah.
They're a huge company, aren't they? But they're a great Australian story. So
great Australian story.
Exactly,
Yeah.
yeah.
Yes.
My humor is good.
In 2005, they were just an idea. They were just an idea. And by 2015, something like that, they were worth $10 billion each year.
Yeah. And I'm sure they were, accessing the R&D tax incentive throughout their journey, which particularly in the early days would have helped them just keep afloat and have that cash flow.
Correct. And we see that with a lot of the early stage companies we work with, they rely heavily on that R&D because Australia doesn't have that risk appetite that much as the US would have. So, so the R&D is probably the one thing that they rely on in terms of the early funding. Yeah.
Raj, the next question is to you. And this is a question that is asked a lot by businesses, and it's about when starting a business. Often we structure the businesses not too well. So, what are the important considerations when structuring a business in terms of income tax and capital gains tax?
A good question, Dinesh. I mean, there's a few structures, the basic structures, right? Well, a lot of people start as a sole trader. They're starting a small business, but that's the easiest. They'll get an ABN and start as a sole trader. And then once they're getting a bit bigger, we then typically would move them into a trust structure or a company structure, mainly with businesses where you're dealing with employees, you're dealing with creditors, you're dealing with banks. We recommend a company structure because you've got separate legal liability so that you're not personally liable. So one of the key considerations is protecting the directors from liability and so on. So by putting it into a company, and now Australia has the 25% tax rates for companies under 50 million. It was 30% for all other companies, but companies under 50 million is 25%. So that's useful to have. And then also from a capital gains tax perspective, it's about one is we have the regime where if you're running a business for more than a year, just like if you own a property and you sell a property after owning it for a year, you get a 50% discount on your shares. So let's say you set up a company today and you sell it, 4 or 5 years for $10 million, you get a 50% discount, right? So you pay tax only on 5 million, which is good, right? So the other thing that's been introduced is, I don't know whether a lot of the viewers know, is this what they call the small business CGT concessions. So they're there to encourage, again, small businesses to set up a business to do well and pay less capital gains tax, right, when they exit. So there are some requirements. One of them is that the value of a business has to be less than 6 million. So it's aimed at businesses that are at the smaller end or have revenue less than 2 million, right? And what it does is it gives you, a number of concessions. So there's something called the active asset discount, which gives you another 50% discount on top of the CGT discount. So basically, if you make a $10 million gain, now you're paying tax not on 5, but you're paying on 2.5 million, right? There's also what they call the retirement exemption. So if you run a business, you're selling it, and you're retiring, you can contribute $500,000 into superannuation and claim that as a tax reduction. So you get that it reduces your capital gain. It goes into super tax free. There's also another one, which is when you've been in business for 15 years. So I remember accessing this for a client of mine a number of years ago. She owned a cafe and she had been in business for 15 years and the capital gain was completely disregarded. So I think it was, if I remember right, it was about $1.5 million in capital gain, but we just disregarded it. So just taking those into consideration is important. There are some rules. I've just highlighted the high level. There's always the devil's in the detail, right? So when structuring and in order to access these concessions, you've got to own at least 20% of the company. So the company got to own 20% of it, right? So we just got to make sure, if it's a mom and dad business or if it's mom and dad or with some other people in partnership, then we need to make sure that the stakeholders own at least 20% of the business in order to be able to access the discount, right? So the last thing is from a trust. We do set up companies in trusts as well. And the problem with trust is that, and same with companies, is that if there's losses in the early days, if they're making losses, they actually, they're quarantined in the trust or the company. And the last thing I think I'll say is I can spend a lot of time on this, but if you're in a partnership, so a lot of people start business as a partnership as well. And the advantage of a partnership and being a sole trader is that if you're making losses, then you can offset that against other income that you're making. So they're not quarantined. Those losses are not quarantined in the entity. They actually can offset against other income that you make, right? But subject to there are some non-commercial loss provisions as well that are there now. So they're aimed at preventing people from starting a hobby and making a loss on a hobby and trying to offset that against income that they're earning, salary and wage income that they might earn. So the devil's in the details. So we normally, typically with the client, when we're setting up, we will sit down and talk to them about, and whether they want to claim the R&D might be another one. Typically with the R&D claim, we're just setting it up in a company. Again, from a risk perspective, right? So we will sit down and understand the profile of the client. What do they want to achieve? What's the strategy? So the short-term strategy, long-term strategy, and then come up with an appropriate structure depending on the stakeholders and so on, the various parties that are involved. So it's not one size fits all. It's just making sure that we set up right. And the importance of setting up right is that later on, if you're in a particular structure and you want to change structures, there are tax implications. So we want to try and sort of set up right to start with, so that along the way we don't try and change it, right? And then there are complexities that arise later when people move overseas or expand overseas to international business. I won't get into that now, but there are complexities there too, right? And where you own your IP, Bianca will also deal with that, with R&D as well. Where is the IP owned and so on? So there are other issues that come in once you go into international markets and do business overseas, like Atlassian we talked about. Atlassian now obviously has their biggest operation in the US. It was an Australian company that went to the US. So those things. So if that's in the roadmap when we're talking to clients, then we take that into consideration too, right? But the whole philosophy is to try and start simple, keep the compliance simple, right? But cater for future plans.
Raj, thanks a lot. There's some absolute gold in there for you, ladies and gentlemen. Raj has so much experience. Thank you, Raj, for sharing that. Ladies and gentlemen, we're also midway already, and there's so much more to unpack and ask these experts of ours. Bianca, I'm coming to you with 2 questions.
Yeah.
I have still a lot more questions for you both, so we probably may have to run through this piece a bit faster.
Yeah.
When it comes to, we're now a few weeks away from 30th June. What are the R&D incentive innovation programs that businesses can consider and should consider? And also, there can be massive impact if you do R&D wrong and you get a lot of the stuff incorrect. And that can have massive impact on businesses as well. Are you able to give us some insights on there, please?
Yeah, sure. So if you're planning on accessing the R&D tax incentive, I think one major thing is to start thinking about now, if you haven't already, about the documentation. So the documentation of your R&D activities, so the fact that they actually happened, but also that they meet the requirements. As well as the link between any costs you're planning on claiming and the R&D activities. The R&D tax incentive, it is a self-assessment program. So similar to your tax return, you won't necessarily get asked questions up front, but you want to be prepared if there ever is a review down the track, which can be sometimes in a number of years. You want to make sure those documents are in a place that's very easy to find, and people also come and go from the business as well, so you don't want all of that knowledge stuck in someone's head who might leave the business. So definitely want to get everything recorded. Another thing to consider is the rules around associate expenditure. So where we sometimes see this apply, particularly with small businesses, is where founders, shareholders, directors of the business are involved in the R&D activities. They're getting paid a salary or a contract expense. And one of the key criteria in relation to associate expenditure is, in order to be able to claim those amounts, they need to be paid in the financial year. So something just to keep in mind, if there are any invoices to closely, related entities that would be considered associates, or, those types of individuals I mentioned, worthwhile getting those paid in a year. Another thing would just be to start your claim now. The deadline to lodge is the 30th of April, but it definitely makes it a lot easier to, as you said before, make sure you get the claim right, make sure you are capturing everything in the business, not leaving anything on the table if you start the process early rather than waiting till April and trying to think back, oh, what was I doing, you know, potentially over a year ago. So I think that's a key to making sure you get the claim right. If you get the claim wrong, I guess the risk is that you could have to repay refunds you've received or tax offsets, plus penalties and also interest as well. So definitely, you know, start the claim early, have that good governance, document your activities, and also I definitely always recommend getting an advisor to at least have a review of your claim before you submit it.
Thank you. Thanks a lot. Some really valuable advice there. If you're doing an R&D claim, get those dates right. Very important to get your claim fairly accurate, not fairly, very accurate.
Yeah.
Now I want to go back to you, Raj. When it comes to salary packaging strategies, and this is for individuals and business owners, what are the strategies that they can adopt, including share options, superannuation, etc.?
Yeah, thank you, Dinesh. It's a big field. I've got specialists at Grant Thornton who look after this on behalf of clients, but high level, you know, things like a car, right? Packaging a car, you know, for example, you know, if you buy an EV, right, at the moment, if it's below the luxury car tax limit, it's exempt from fringe benefit tax. So there's a big incentive now to buy an EV, right? And the cars that are coming under that the luxury car limit can be packaged in, you know, very tax effectively. A laptop can be packaged in, right? So, you know, tax-free, one electronic item per year. Superannuation, you know, depending on cash flow, right? You know, the employer has to contribute. I think it's 11.5%. It's going up by 0.5% every year. Might be 11.5 or 12. I'm not sure what the exact number right now is. But then the limit per employee is $30,000, right? So if you're contributing, let's say 11.5% of 100,000, that's 11,500. But you can make an additional salary sacrifice contribution to take it up to 30,000. So you could do another 18,500. So cash flow permitting, right? So obviously work with the financial planners. Financial planners will talk about how effective superannuation is in terms of retirement planning, because once you get to the retirement phase, you're able to, you know, get into a tax-free environment and then draw that money to support your retirement. In terms of hiring talent, and we see this particularly in the technology sector, you know, developers and so on can be expensive. So one of the things is if you're an early stage company, then you might offer options and so on in the company. So if somebody's going to, you know, cost you $150,000, you might give them $100,000 salary and $50,000 worth of options. So the whole idea is that there's a couple of benefits there. Is that one is that you're sort of aligning your employees with your vision. So you're saying, okay, you know, come be part of the game. There's skin in the game, right? So we're going to grow this business together. We're going to exit this business, and we're going to make a lot of money, and you're going to get a part of it. And then also the other benefit is that for early stage businesses, these options can be converted to capital gains. So at the end, you're paying capital gains tax as opposed to income tax. So if that was paid as a salary, you would have been paying tax at, let's say, 45%, but now you're paying capital gains tax at 22.5%. So it's a benefit to the company because they don't have the cash to pay them $150,000. They're giving them options. They're aligning their employees with their strategy, and also benefit to the employees that at the end of that period, they're going to get a lump sum amount, right? So I talk to, you know, entrepreneurs and founders all the time and say, okay, you're going to have a $20 million exit. Why not give $2 million, 10% to key employees, and give, let's say there's 4 key employees in your business, they might get $500,000 each, right? So that alignment. And when we talk to entrepreneurs and business owners, and I'm sure Bianca is the same, it really comes by the people. If you have the right people in the business, they're going to help you achieve your goals, right? Because the entrepreneur alone, him or her alone, cannot do it, right? So the very early stage, yes, but then as you're growing and expanding, you need to bring talent in. And it's the talent in sales and marketing and HR and IT and so on, R&D. These are the people who are going to help you grow the business and take it to the next level. Yeah. So we've got specialists to do that. It can save you a lot of money. It can save you a lot of money because it might be a little bit of money each year, but over 10 years, over a 20-year period, it adds up to a lot of dollars.
Amazing. Thank you. Thanks a lot, Raj. Very valuable again. Bianca, I'm going to come back to you.
What?
Again, I'm going to keep you within the grants framework again. This is not about innovation grants or R&D grants. It's about what are the other grants that business owners must know that are available to them. And also, I'd like you to expand on the export marketing grants or the EMDG grant that is out there, and whether there's any update on that.
Yeah, sure. So throughout, I guess, any given year, there's a whole heap of grants ranging from, smaller to larger grants from local council, state government, and also on a federal level. So there are quite a lot out there, but they are often, they're not open generally for large windows, and they do have a lot of strict requirements. What we're seeing is that a lot of grants are aligned with key priority areas that the government has. So just to name a few, some of those areas are agriculture, defence, life sciences, renewables, critical minerals, and space. And also we see often grants for rural businesses or companies undertaking projects in rural areas. Something to keep in mind with grants as well is that often they're forward-looking, so it needs to be generally a planned project that you haven't spent any money on yet. And they are competitive, so that's where it is worthwhile potentially getting a grant specialist in to, at least sort of review your application so you are putting your best foot forward and increasing your chance of success. A few programs open at the moment. The Industry Growth Program, or the IGP, that's a program for small and medium businesses looking to commercialise and expand their business in, some of those key priority areas. It's sort of two phases. It offers an advisory service and then also grants as well for projects if you're successful. Something that was flagged in the budget is, in addition to the energy bill relief that Raj mentioned before, there's some planned energy efficiency grants of up to $25,000 to support companies with managing energy usage. So, keep an eye out for that. I also saw at the moment in New South Wales, there's a grant program around EV fleet. So if you happen to have a fleet of cars that you're looking to transition to electric, there's a couple of sort of aspects of that program. It's open at the moment, but might be worthwhile looking into. And then I'll just touch lightly on the export market development grant. So that's a program that's been going on for quite a number of years. It's really to support companies exporting their products or services overseas. The most recent round closed at the end of last year, so it's not currently open at the moment. It's planned to open again probably later this year. We don't know when that will be. The program recently changed a little bit. So it used to be everyone that applies gets some grant funding, but then what would happen is everyone sort of wouldn't get as much as what they were expecting. So it's changed from in the most recent round where it's first in, first served. So I know the program opened, and then I think it was in maybe 2 hours the funding was allocated. So it was quite a rush for everyone. But just wanted to keep your eye out for there, because it may open at any point during the year. But if you're exporting or planning to export, keep that one in mind.
Bianca, thank you. Some great points there. Bianca, if somebody wants to get more information, where can they look out for, especially, that EV fleet grant? These are new grants. Then the other one was it the IBS or?
The Industry Growth Program. So the challenge is there isn't necessarily one website that lists every single grant. It's worth having a look at, the state government website, federal and local council website. There's generally a sort of email address you can sign up for each of those to get alerts about specific grants, and they include a sort of directory of grants. The other thing would be our website. So we don't include every grant, but the ones that I mentioned today will, generally put out updates and alerts around some of the key programs that are opening, key dates and things like that.
Amazing. Thank
Yeah.
you.
So we do have grant specialists, right?
Yeah.
So yeah, happy for any of your audience, Dinesh, to reach out to us either directly to us or via you, and we're happy to have a no cost discussion about their business and whether they could be eligible, right? And we'll be very transparent about what's out there. Like Bianca said, there's a lot there at a state level and at a federal level, right? But our team can narrow it down to what might work depending on the industry areas and so on, and have that discussion. Yeah.
Fantastic. We have about another 10 minutes left and quite a few more questions to cover.
Yeah. We'll be fast.
Having said that, would it be okay for some of the attendees to connect with you both on LinkedIn?
Yeah,
absolutely.
Fantastic. Thank you for that. And I also want to make sure that everybody understands this is not advice. This is for informational purposes, educational purposes only. We have these experts coming to us, and I ask them all these questions that are sent to us, but they, advice is very individual and it's done professionally. So this is not advice. All right, this is for you, Raj. And by the way, there is a question that has come through, but I will ask you the question. You don't have to answer it because it might be very individual and you may have to give that separately. But if this question is about how should a business owner access or take profits out of a company in a tax-effective manner? That wasn't the question I mentioned earlier, but this is just one of the general questions.
Yeah.
How should a business owner access or take profits out of a company in a tax-effective manner?
Yeah. Yeah. So generally, Dinesh, a couple of rules, and I'll keep it fast, right? So when we're paying a business owner a salary, we want to keep the salary below $180,000 or $190,000, because once you're above $190,000, you're paying 47.5% tax, right? So, or 45 plus 2. So we generally say to business owners, pay yourself up to 190, but some of them might be lower, depending on their profitability, on their cash flow, and so on. And then beyond that, generally the way businesses are structured is that the way we structure them is for the ownership to be owned by trusts, right? And we would take them as dividends. So because what we call fully franked dividends. So the companies pay tax on it, and so they're called franked dividends, and then dividends get distributed to trust and then on to beneficiaries, so that then they can then go and invest that money and access lower tax thresholds of their beneficiaries. Could be their spouse, could be adult children, and so on. And it could go up the tree to parents and grandparents, children, grandchildren, go sideways to brothers and sisters, and so on. So the family tree can be quite a big tree, and depending on their circumstances, we can distribute. We also have these rules that are called Div 7A rules that were put in place because some time ago, I think the rules came in probably 15 years ago. People used to just take money out of the company, just borrow money from the company, and they just sit as loans. And the tax office turned around and said, no, that's not correct, because you pay tax at 25% or 30%, and you're taking money and using it for personal use to buy a house or go on a holiday. Now that's going to be taxed at your marginal rate. So we've got to put loans in place. So we do these Div 7A loans, which are going to be repaid over 7 years, or if they're secured against property over 25 years. Mm-hmm. Or you might even borrow money to invest in an investment property. So, and in those circumstances, it can be tax effective rather than take it out as a dividend, to do it as a loan and to put a loan agreement in place. So effectively, in that example where let's say buying a property, and rather than going and borrowing money from the bank, you're borrowing money from your own company. So let's say your own company's got $1 million. Do I take the $1 million out and pay tax on it and then use the money, or do a loan agreement between the company and myself to loan that money? So rather than pay interest to the bank, and we know what banks do with our interest, they probably don't know what they do with it actually. So where you pay interest back to yourself. So there's different ways to do it, and again, obviously there's laws, and we work within the laws, right? But general rule is salary is up to about 180, 190. Beyond that, dividends or loans.
Thank you. Thanks a lot. Very valuable again. Raj, we have 7 minutes more, but I'm going to ask you this question. I need
yes, quick answer.
Your top three tips for businesses from a tax planning perspective before 30th June.
Yeah.
In 1 minute.
Yeah, so it's all being proactive, not reactive, right? So there are certain things you can do before 30 June. Bianca said, for example, R&D, you've got to make the payment before 30 June, right? Superannuation, to claim a tax reduction, you've got to pay it before 30 June. If you've got bad stock, you've got to write it off. You've got to write it off before 30 June. If you've got bad debtors, you've got to write off before 30 June, right? Things like income, there's a contract that's, can be invoiced in July, wait till July, as opposed to June, right? So the benefit of these is that once the year is locked in and 30 June is passed, you're going to pay that amount. You made $1 million profit, you're going to pay that $250,000 tax to the taxman. And he's not going to give it back. Once you give it to him, it's very hard to get it back, right? So this is just planning to actually minimize the tax so you retain more money in your business to help you grow your business, pay your employees, grow your business, do more research and so on, right? So we said to our clients around May time, look at their results, sit down with their accountant, and look at things that they need to put in place before 30 June. It could be investing in assets or technology and so on. Yeah. We have talked about this in the past, Dinesh, right? You've got to incur that cost before 30 June, then incur the cost. So you get the benefit of the additional tax reduction and so on, which used to be available, right? It's not there anymore, but it used to be available during the COVID time, right? So it's really being proactive rather than reactive, right? And sitting down, and May is a good time to sit down with the accountant and discuss your plan.
Thank you. Thanks very much for that. I do still have a couple of questions for each of you, or one question for each of you. And this is more about some examples of how you helped each of you. We'll have different examples, of course, but can you share with us a recent example of how you helped or assisted a small and medium-sized business owner? Can we start with Bianca this time?
Yeah, sure. So I can't share their name, but I guess a company that is sort of a bit of a good news story. I started working with them when they were just a startup, so they didn't have a lot of processes and things in place. So got into the business, really helped them create processes around the documentation of their R&D claim. As I've suggested a few times, started working on their claim during the year so that it was a lot easier to prepare their claim at the end of the year. They documented their R&D throughout the year. As soon as the year was finished, we could quickly wrap up their claim and they could get that cash refund, in sort of August, which really helped them continue operating for a number of years when they were pre-revenue. And then throughout that journey, the company grew quite a bit. It was quite nice to see that how that R&D tax incentive was helping them throughout that process. And then ultimately, I worked with some other colleagues at Grant Thornton, and we supported the owners to exit the business through a sale to a large big pharma company. So it was quite a good news story of how the R&D tax incentive can sort of help a company from those early stages to grow and then get to a point where it's an attractive business for sale.
That's amazing. That's an amazing story, Bianca. Congratulations on that. Especially with startups being very cash poor.
Yeah.
And so that also shows that startups can come for large firms like Grant Thornton for R&D. And would you mind if I ask you? You don't have to answer this. Is that because you charge them a percentage of the fee of what they get, or is it a retainer? How does that work?
Yeah, so generally we offer a fixed fee on our engagements. We can sometimes, depending on the scenario, offer a percentage, but I guess we have that, sort of first discussion with the client to get an understanding of the complexity and the size of the claim to make sure our fee's not, eroding any of the benefit to the business. So the business is ultimately retaining the majority of the benefit associated with the claim.
Fantastic. That's a really great story, because you think, get these big organizations like Grant Thornton and startups, it's not the place to start up. But here, there's so much value that is added, and then you help them to exit that business. So, great, good news story, as I said. Raj, over to you. Again, we have a few minutes, but would love to hear
Yeah, I'll be a couple of minutes. Yeah, we take a very client-centric approach, Dinesh, at Grant Thornton, and I think we have known that from our relationship with you as well.
Thank you.
It's about doing the right thing by the client, right? And it's about the life cycle of the client. And we've got experts from different areas who can help at different times, including industry experts, R&D experts like Bianca, GST experts, corporate finance experts, and so on. So we bring people into the discussion at the appropriate times to get the best outcome. My example, Dinesh, I do a lot of what they call fractional CFO, virtual CFO work. So this engineering client that I work with in the last few years, they've had ups and downs through COVID. Has been challenging times, right? So we had to manage some grants through the COVID period. As I'm a JobKeeper, JobSaver, all those things came in. Before that, we had to take a 20% pay cut, including the management. There's about so many people working in the business, so we had to manage the budgets very tightly, cash flow very tightly. Everybody had to take a pay cut. We had to get through that year. We came out of that year. Then there's challenges, right? Let's say the industry is going through change. Pricing is very competitive, right? So we are constantly looking at their profitability, their cash flow, their forecast, managing payments with the tax office. Some people tend to use the tax office like a bank, but the tax office can only take so much. So we have to be very upfront with the tax office, negotiate with them in terms of payment plans and so on. Trying to bring in some external investors, talking to Macquarie Bank, who are bankers, to see where they can provide some additional working capital funding. They also set up in the UK and in Hong Kong and Denmark. So there's some transfer pricing issues. In the countries, every country has its own rules. So dealing with the rules in those countries, make sure we comply. So there's commercial issues, there's financing issues, there's motivational issues with the team, holding them together through difficult times. They're actually going through their budgeting process right now for next year. They've got a new CEO on board. So we're working with the new CEO now, who's coming obviously and wants to achieve certain things going forward. So it's ever changing. We're in there. We are partnering with them, and it's always we put ourselves and we partner with the clients to get the best outcome. And we are there in difficult times. We don't walk away and say, look, the times are difficult. We're going to walk away. So the strength of our relationship is we're there when times are tough, and we've got many examples of those. And then we want to come out on the other side, right? Hopefully, come out better, bigger, better, and stronger. So that's our ethos.
Thank you, Raj. And I have seen you living that ethos, especially. I see you helping so many startups, so many businesses. Some of the advice we've got, from yourself has been invaluable, and we are extremely grateful to you. So thank you for living that ethos that you mentioned.
Thank you.
And even in that example, there's so much value that is created where a business is going through hell, especially at times like COVID, and you are there helping them, and all what you've done during that time is not just finance, it's so leadership oriented, operational, finance, everything, motivational as well, as you mentioned. So that is amazing. Again, I want the audience to know this is the 6th consecutive year these experts have come to us. They, as you saw, they're absolutely frank in the way they answer their questions. Raj and Bianca, we're absolutely grateful to you and Grant Thornton for sparing your time answering these questions. They're going to be invaluable. We're going to share them in social media, on YouTube, etc. So they'll be there for others who are not here live to listen to as well. There was one other question. In case anybody has to leave now, you may leave, but I'm going to ask that question that came through the audience. Again, as I mentioned, Raj, if it's something you feel that it needs to be handled one-on-one, you can do that as well, because this is not for advice. But the question was asked earlier on when you were talking about structuring a business.
Yes.
When businesses start, have a structure. And the question that was asked was, say, as businesses are starting, nobody gives them loans. Banks don't give them loans, and nobody gives them funding. It's very hard to get investment.
Right.
So what business owners do is they mortgage their home and and take a personal loan, and they use that
Correct.
money to fund their
Correct.
business. But while the money is in the business, it shows against as a loan to the founder. The
Yes.
founder ends up paying the mortgage to the bank from their PA.
Yeah.
Whatever.
Correct.
You're getting messed up on both sides.
Correct.
How do you advise people to structure correctly in such a situation? What are the avenues available so that they're not paying tax on the to pay their mortgage, for instance?
Yeah. So that's the easiest option there, Dinesh, is what you call a back-to-back loan, right? So the individual has borrowed, let's say, $100,000 and put that in the company. Individual is paying, let's say, interest at 7%. So the individual is paying $7,000 in interest, right, in their personal name. The money has been used in the company as working capital. So the recommendation is the company pays the individual $7,000 in interest, right? Because the individual has borrowed the money from the bank, on lent the money to the company. So the company pays the individual $7,000, claims the tax deduction, and in the individual's name, it's in and out. Individual receives $7,000 in interest income of the company, pays $7,000 to the bank, so it's in and out. So the net position for the individual is nil.
Amazing, amazing.
Yeah, yeah.
Invaluable. Again, absolute gold, ladies and gentlemen. Bianca, is there anything else you have any parting wisdom you have for us before you leave?
I think just keep an eye out on the various websites to see if there's any potential grants you can access. But I think the R&D tax incentive is one that's particularly good because, as I said, it's not a competitive process. So as I said, if you're developing a new product, process, service, if there's a project where it's really a challenge, there's a lot of complexities, there's failures, have a look into the program and see if it might be something you can access.
Amazing. Thank you very much. Raj, again, thanks very much for your insights, the absolute goal that you both shared. Raj, I know you're very experienced, and this is the 6th year in a row we've had the absolute honor of having you as part of this program.
Thank you, Dinesh. I'm going to say one thing with clients when they see us, like you just mentioned, funding issues and so on. We are constantly working with people out there, VCs, private equity firms, high net worth individuals, right? Banks as well, non-bank lenders as well, to find working capital for companies. So we're always happy to have a chat. So we don't limit ourselves just to provide the accounting tax structuring. We're taking a holistic view, and we might not be able to do something straight away, but we might be able to do something along the way, right? And part of it may be raising money from some angel investors and so on. So happy to look at the holistic thing because funding is a big part of a business, right? And there are challenges, and we need to have some reserves along the way. So happy to have a holistic chat with any of your clients when it comes to working out their business, their strategy, their exit, their funding, and all those things, international expansion, all those things. So we take a holistic view and meet with them on a regular basis to see how we're going against those objectives and to guide them along the way. And it's a partnership, a working partnership. So happy to offer like a complimentary discussion with any of your clients if they wanted to have a discussion to come into our Grant Thornton office here in the city and have a discussion over a couple of hours, get some coffee and sandwiches. Yeah.
There you go, ladies and gentlemen. That's amazing. Jen, by the way, has shared the LinkedIn contacts of Raj and Bianca, so you may contact them directly if you would like, or come through us. We can organize that. Raj, thank you for that offer. By the way, I've been to the Grant Thornton's new offices in the city. They are fabulous. I've seen some very good offices, but your one takes the cake. Congratulations to Grant Thornton.
Simple but nice, right? We are not overindulgent, not extravagant. Yeah. Yeah.
Very, very classy, very classy. But as you said, simple, nothing over the top. Very functional, and very.
It reflects our culture.
That's it. Very accommodating, and people are so friendly. That's what's most beautiful. Thank you again.
Thank you.
Thank you.
There are no more questions, so I'm going to end the webinar. Until next
meet again.
financial year, 7th in a row. We'll
Good.
meet again. Thank you again. Thanks, Raj. Thanks, Bianca. Thank you, everyone, for joining us. Great to have you join us. Take care. Bye-bye.
Thank you, Dinesh. Bye-bye. Have a good night.